I made $56,000 in one day using SMT Divergence. I know these setups seem complicated, and most traders take every single divergence and wonder why they keep losing money. I used to do the same exact thing until I discovered what I'm about to share, and it completely changed my trading. In this video, I'm gonna break down exactly how I spotted it, entered the trade, and managed the position, and how you guys can spot these setups too. So without wasting any more time, let's get right into it. Okay, let's firstly talk about what SMT divergence actually is. In simple terms, it's really gauging two correlated or inversely correlated assets, whether they are strong versus weak. So we're talking about relative strength and weakness across two correlated or inversely correlated assets. Now, for the purposes of this video and trade breakdown, I'm going to be talking about the dollar against the euro, because that's the trade that I took, but this will also work with index markets. So for this example, we've got the euro dollar. You guys can see here very clearly that this pair, right, is going to be correlated with the dollar because it's measured against it. But this will also work if you're trading index markets like NQ, ES, and YM. So NQ, right, NASDAQ, ES, and the Dow. When we're trying to find relative strength versus weakness, if we're measuring all three of these together, this is how we're going to be able to spot SMT divergence. Now, like, what is SMT divergence and how can we spot it? Essentially what it is we have two markets that are not in agreement, so they're not in sync. That's causing the divergence. So for this example, what I'm looking for is this. So the dollar is creating a higher high, but that means the euro, right, if the markets were in sync and there wasn't any divergence, that means the euro would create a lower low. But in this trade example, that's not the case. So for the purposes of this video and spotting SMT divergence, essentially what this means is, let's say we have the dollar here and the euro. Really what this signals to us is that there's strength, overall relative strength in the euro. This is where we're going to be able to spot where smart money is accumulating long positions, because if the dollar is creating that higher high, euro really, if the markets were in sync, euro should be creating the lower low. Okay, but it's not doing that. It's not creating that lower low. So if markets were in sync and dollar really wanted to continue higher, right, you need to see euro going lower. So just quickly, very easily representing this, you have previous day's high. So when we have a previous daily high being swept out on the dollar, what would you expect? You would expect the previous daily low to be swept on the euro. When you don't see it being swept out, this is giving you the indication that there's strength in the euro. Okay, very simply put, when we're looking for divergence, these markets should be in sync because they're inversely correlated. Okay? And the market structure should be in agreement. When it's out of agreement and out of alignment, there's an opportunity for us to take advantage of that in the market. Just very similarly with like NQ and ES. Let's say ES is creating a higher high. And let's say if we're bearish. ES created the higher high, but NQ failed to make a higher high. Which one is going to be the weaker asset? So we have ES here, and we have NQ here. Which one of these is the weaker asset? Very clearly, it's NQ, because it's creating a lower high. So when we're trying to filter out our trades and our markets that we're trying to trade, we're trying to go to the asset that is relatively strong or weak versus the baseline that we're looking at. Okay? So if you're trying to pick a long position between the euro and the pound, let's say the pound created a lower low. Well, that's telling you that that market is actually weaker than the euro because the euro failed to make that lower low. So if I had to choose a market to trade, right, if Dixie's making that higher high, right, but I'm overall bearish on the dollar index, I'm looking for that asset that is going to show me overall strength. So instead of me trading the pound, I'm going to go into the euro. And this is something that I learned over many, many years, was when I had a bias on a baseline. So for this example, the dollar, when I had a bias, I would try and short, let's say if I was bullish on the dollar, I would try and short the euro, the pound, the Aussie dollar, the New Zealand dollar, all at the same time. And what would happen was some of those currencies showed relative strength. So if I was expecting every single foreign currency to go down, some of them were actually going up. Okay, so you're trying to find the market that aligns with the bias that you're using from the baseline, because you're not trying to short every single foreign currency when we get a setup. Right? It doesn't work like that. Sometimes you'll see the euro much weaker than the pound and much weaker than the Aussie dollar. Sometimes when the dollar is doing one thing, those foreign currencies could be doing the complete opposite because they have relative strength or weakness versus the dollar. So when I'm trying to spot out SMT divergences and how I actually trade them, because not all SMT divergences are going to work the same. Some of them will be strong. The key is you need to have a high time frame draw on liquidity. So breaking down this dollar chart, okay, so this is Tuesday, the 11th of February. Now, if you check your calendars, Wednesday was actually CPI. So what I'm looking for ahead of the CPI release are just indications that maybe the draw on liquidity is either higher or lower. So when I come into this market, all right, I'm spotting out what? This pin bar. We're trading up in this order block. We have a nice bearish fair value gap, and we have low resistance liquidity below us. So we have these daily lows that are below us. Now, ahead of the market open, I don't know if this market is going to trade lower, but I have somewhat of an indication where my draw is, okay? So I am bearish on the dollar. Regardless of whatever price action appears overnight, I'm bearish on the dollar just based on what I'm seeing in the market right now. Now, looking at the euro, I have a very clear draw on liquidity up here. So these are my equal highs that I'm trying to target. Not only that, but we have this daily volume imbalance. And we have a daily inverted fair value gap. So we have a lot of indications that the euro actually wants to trade towards these equal highs. Again, this is Tuesday, the day before CPI. By the way, guys, SMT Divergence is just one of the many trading setups that I use in my day-to-day process. If you guys are looking for a full downloadable PDF covering all the entry techniques, stop loss placements, and other tips, make sure you download my ultimate guide to trading executions. I'll leave a link in the description. Now, let's get into the actual trade so I can walk you through the spotting of SMT Divergence. So we're just walking through price action right now. We're coming up very close towards the actual news release. So we have our previous daily high there, right? And just keep in mind we have this daily fair value gap that we're also looking at. So here's our CPI print. Okay, and this is on a 1 hour time frame, mind you. As we're taking out this previous daily high, all of a sudden, I need to spot the market that I'm trying to trade. So if I am bullish on the euro, if I flip over into this chart, okay, this is actually our previous daily low. So if I bring up this is our Tuesday's low. Now if I drop back down again into the lower time frame, now notice how the euro did not take out its previous daily low, while dollar took out its previous daily high. So if we're measuring these side by side, right, the euro is doing this. It's creating a higher low, but the dollar is doing this. It's creating a higher high. Okay, so that's automatically tipping off that the euro is showing strength. So when I see this occurring, us failing to take out the previous daily low, this to me shows that the euro is very, very strong. Because if the dollar is taking out its previous daily high, the euro should be taking out its daily low if this market were to go lower. That is when markets are in sync. But when we have SMT divergence showing us this, okay, so not only is it failing to take out the previous daily low, we're also trading into what? A daily volume imbalance as well as a daily inverted fair value gap. And our draw is all the way up here. Our draw is all the way up here in the form of equal highs. So really what we're looking to do is just go long because we're assuming that this run on this previous daily high is what? A false run on liquidity. So this here, we also have a 1 hour bearish fair value gap. So when we're looking at this, this is how we're able to spot if this run on liquidity is false or not by looking at other assets. We need to pay attention very closely because the euro is in a really, really great spot to go long and touch trade this level and put our stop loss possibly at the low. right? We might put our stop loss. If we were going long in here, maybe we want to even just use the low end of the daily fair value gap or the daily volume imbalance and go long as a touch trade. So as soon as that hourly candle closes, let's just say you entered at the top of the hour. And with CPI, I typically give myself, you know, anywhere from 15 minutes to half hour, all the way up until an hour before I actually participate in the market. So at the closure of this hourly candle, we could just assume that this run lowers is false because we're not taking out the previous daily low. There's strength in the euro. So I'm trying to position myself long. Okay, I'm not entered. There's no confirmation that I'm waiting for. The only confirmation that I'm getting is that this market is strong because we did not take out the low. So you can touch trade this level, enter long as soon as the candle closes with a target, you know, maybe at this swing high here. Okay, and that's what we're looking for. We're just looking for a 3R trade because, right, the dollar and the euro are not in sync. So with the dollar taking out that previous daily high, we obviously have some levels down in here that we're trying to aim for. So let me get into the actual trade execution. So you guys can see here that I actually took a loss ahead of CPI. And I was confident that this market was possibly going to just respect that daily volume balance and this daily inverted fair value gap. You guys can see with these blue and orange shaded levels, I actually went long here, just 2 contracts, but I was stopped out on CPI. So after I got stopped out, I just tried to reassess the situation. This is when I spotted the SMT divergence. Okay, after we got the hourly close, you guys can see at 9 a.m., got the hourly close, I pretty much entered right at that hour. So after the rollover from 9 a.m. going into that next hour, I entered long, okay? And then I scaled in another position. Now you guys can see here, after I scaled in the position, it spiked. So if you guys look at this price, 1.03575, if we look all the way across, okay, this is 1.03600. So I actually got in before it spiked. So this is part of scaling into the trade. I was very confident in this trade because I was getting that signature of SMT divergence. All right. So I was able to enter long here. This is a very, very, very good risk to reward trade. So even if I lost a little more than 1R because I got slipped on this initial position, I was able to make up for it just by framing a better risk to reward trade on that next entry. Okay. So if I was down 1R or down a little bit more than 1R because of slippage on CPI, I'm able to make it back by placing another 1R trade, but the upside has a great amount of potential. So after we got this run here, I was able to adjust my stop loss because we have a smaller 5-minute fair value gap. If you guys can't see it down here, I was able to scale in. I adjusted my stop loss, and then I was able to scale in. And this allows me to put on more size without assuming more risk. Okay, so before I scale into any positions, you guys can see here, I bought 2 here, bought 2 here. Before I buy that, before I make that second execution and buy 2 more contracts, I have to be able to reduce the stop loss on my initial entry. Because if I don't, now all of a sudden I'm exposed to 2R in possible risk to the downside. And if I really wanted to, you guys can see here that as this market came back and retraced into this 5-minute fair value gap, I could have possibly added in again if my stop loss was at break even. So even if I added a third entry, I would have been able to, you know, almost essentially triple my size without taking on more risk. Okay, so this is how you can turn a 1 to 2 or 1 to 3 or 1 to 4 trade into a 1 to 6, a 1 to 8, because your open exposure never exceeds 1R. Because if you get stopped out of all 3 of your positions, right, 2 of the positions are getting stopped out at break even or even a little bit of profit. So your first position is getting stopped out in a bit of profit. Your second position is getting stopped out at break even. And then your third position is getting stopped out for a loss. Okay, so it pretty much mitigates that risk. So again, as you can see, right, the daily on the euro failed to take out the previous daily low. And this is really all I'm looking at. I'm looking at the daily time frame, and I'm just using the lower time frames to get in sync. I'm not really using the lower time frames to find setups. My setups are always coming off of a daily 4-hour or 1-hour level. I'm never using the low time frame to spot my bias and my setups. All right. I'm just using it for a timing tool. You guys can see here that I timed it pretty perfectly. I pretty much bought the low of the day. And you guys can see here, right, daily SMT with EU. We're still inside this bearish fair value gap. We have low resistance liquidity below us. So here, right, the first move on CPI, oftentimes false. So you guys can see here, right? I took a loss initially. So I have $1,100 in realized loss. But you guys can see here, me being able to scale in, I'm making back that loss by almost 3 times, right? Without assuming more risk. So if I lost $1,000 on this trade, my first entry, I was risking another $1,000. And then my second entry, I was risking $1,000. But that first entry was moved to break even. So if I got stopped out of both positions, I'm only losing another 1R. So as this market was trading higher, right, we were getting additional validations to hold the position. So you guys can look on the 1 hour time frame. We inverted that sell sign imbalance, and this is that retracement on that next hour is really where that third entry could have been. All right, and this is where patience and experience is going to come into play, because how many of you guys may have puked that trade as it's trading against you? Okay, because it almost came back, and I gave back a fair bit of profits. I was up, almost 3R, came back probably up, 1R on this retracement. But I'm not worried about the P&L. I'm more concerned with, I have proper risk to reward on, and I have a clear draw on liquidity that I'm trying to aim for. I'm not concerned with the P&L. I'm just trying to look at the charts and make good trades. So again, right, both of these positions are running very nicely in profit. So there you guys can see me scale out the full position. And look at the time aspect of it. We're a little bit past noon. So I'm taking into account, right, a lot of time of day. I'm thinking about, all right, this next 4 hour candle could possibly cause my position to turn around on me. So I was really only trying to operate within that 1 4 hour candle. And as you guys can see, we took out that point of liquidity. So here you guys can see I fully closed out those positions and made roughly $2,200 across 25 funded accounts. Look, these trading setups aren't the only reasons I'm successful. I spent nearly a decade in the markets before I truly became profitable. But I did you all a huge favor and put together 7 of the biggest lessons I've learned, so you don't have to go through the same struggle. You guys can check that video out right here. And as always, thanks for watching, and I'll see you guys in the next video.